Okay, welcome everyone to this pre-recorded presentation of a new LB&L report titled An Analysis of the Costs, Benefits, and Implications of Different Approaches to Capturing the Value of Renewable Energy Tax Incentives. My name is Mark Bollinger, and I'm the author of this report. I've got 18 more slides to run through, and the whole recording should take around 30 minutes. So the overarching purpose of this work is to explore the potential impact of a number of plausible future policy scenarios on how utility-scale wind and solar projects are likely to be financed going forward, which in turn impacts their levelized cost of energy, or LCOE. This work is motivated by the fact that the utility-scale wind and solar markets are currently heavily reliant, some might even say over-reliant, on a very expensive source of capital known as third-party tax equity. Specifically, if a developer or project sponsor is unable to efficiently take advantage of the federal tax benefits that are provided to both wind and solar projects, then it will often bring in a third-party tax equity investor who is able to efficiently use the project's tax benefits and who invests in the project in exchange for being allocated most or all of its tax benefits. This is known as monetizing the tax benefits, or in other words, converting their value into money that can be used to finance the project. This is all well and good except for the fact that tax equity is an expensive source of capital. You can see in the graph here by comparing the red and blue lines, both of which are expressed on an after-tax basis. You can see that tax equity is currently twice as expensive as the project-level term debt that it displaces from the capital stack. Even so, the benefits of tax equity must still outweigh its incremental costs, otherwise no project sponsors would ever choose to use it. But looking ahead, there are a number of plausible policy scenarios in which the benefits of tax equity may no longer outweigh its high cost. If any of these scenarios come to pass, you would likely see a shift in how wind and solar projects are financed, namely moving away from tax equity and towards cheaper sources of capital like long-term debt, or perhaps in the future towards something like a master limited partnership. All else equal, this financing shift would result in lower PPA prices. So again, the purpose of this work is really to develop the financial models to explore some of these scenarios, to see what impact they have on financing structures, and in turn what that means for LCOE or PPA prices. The methodology used in this report is based on modeling the three different ways in which a wind or solar project sponsor can extract at least some value from the federal tax benefits to which it is entitled. So the graph up top here shows the profile of tax benefits generated by a wind project over time. And they're expressed here as a percentage of total capital costs, or CapEx. So the dark green bars show depreciation benefits, while the diagonally striped bars show production tax credits, or PTCs. The red upward sloping line basically represents the project's ability to use these tax benefits over time based on its taxable income from PPA and REC revenue. And what you can see is that in each of the project's first 10 years, the combined tax benefits exceed the project's ability to absorb those tax benefits on its own, meaning that some of these tax benefits, those that fall above the red line, could potentially go to waste. Well, it turns out that there are three ways that project sponsors can extract at least some and perhaps all of the value from these excess deductions and credits that fall above the red line. First, if the sponsor has what is known as tax appetite from outside sources of income, so for example, maybe from ownership of other generation assets or from other business activities altogether, then that sponsor can most likely apply these excess deductions and credits against that outside income. In this case, the sponsor can effectively realize in real time the time profile of tax benefits shown in the top graph. If the sponsor does not have tax appetite from outside income, then it can still realize the time profile shown in the top graph by bringing in a third-party tax equity investor, which is typically a large investment bank or insurance company that invests in the project in exchange for being allocated most or all of the project's tax benefits. So this is a second way to essentially realize in real time this time profile shown in the top graph, though this second method of partnering with tax equity does come at a cost because, as noted earlier, tax equity is an expensive source of capital. Finally, if the sponsor does not have tax appetite on its own and is unable to find a willing tax equity partner, then it can carry forward the tax benefits for up to 20 years until they can be fully absorbed by the project itself. And this is what's shown in the bottom graph. Obviously, there's a disadvantage to this third approach due to the time value of money. As you can see in the legend, the present value of these combined tax benefits comes to just 31% of total CapEx in the bottom graph, compared to 57% in the top graph, even though both graphs show the exact same overall magnitude of tax benefits. The only difference is the timing of when those benefits are realized. So just to sum up, in case it's not already obvious, the top graph shows the best case scenario, while the bottom graph shows the worst case scenario. And the methodology adopted in this report is essentially to use these two extremes to bookend the range of possible outcomes under a variety of future policy scenarios. Okay, in order to explore the trade-offs between monetizing tax benefits or using them internally, I developed 3 different financial models that mimic or replicate the financial structures that are most commonly used for utility-scale wind and solar projects today. So the first of these is what I'll call a sponsor equity and debt model, which is relatively simple because it does not involve third-party tax equity. Instead, it simply assumes that the project is financed by some combination of sponsor equity and project-level term debt, with tax benefits carried forward as needed depending on the sponsor's tax appetite. The second model is of a sale-leaseback structure, which is a tax equity structure that's been used primarily for solar rather than wind projects, and that's mostly because leasing is not really compatible with the PTC. And then the third model is a return-based partnership flip structure. This is also a tax equity structure that is quite common in the wind sector, and that has been described in several of our past publications. All 3 of these models solve for the minimum levelized PPA price that is required to recoup all costs and meet all constraints, such as debt service coverage ratios, while also providing the project sponsor and or tax equity investor with their required rates of return. And I think that's all I'll say about the models themselves. Anyone interested in more detail on any of these can take a look at Chapter 3 of the report. So here are the modeling assumptions that I used. Those in the top left table do not vary across models or financing structures, while those in the bottom right table are related to financing and so actually do vary somewhat across models. Just a few things to quickly note here. First, I've modeled solar at 3 different capital costs, ranging from $3 per watt down to $2 per watt AC. And this is primarily because the cost of solar has been dropping rapidly in recent years, and a number of the future policy scenarios explored in this report, particularly for solar, would not kick in until a few more years down the road, by which time solar costs could be lower. Also, looking at the same solar scenarios under different capital cost assumptions actually reveals some interesting financing impacts that I'll talk more about in a few minutes. I'm assuming a 25-year power purchase agreement, or PPA, so all of the analysis that I'll be showing is over a 25-year period, and all of the PPA prices that I'll show are levelized over 25 years. In the bottom table, the 2 models involving tax equity, so by that I mean the sale-leaseback and the partnership flip models, do not make use of project-level term debt, although the partnership flip model does allow the project sponsor to finance its equity stake using what's known as back leverage. So I think I'll leave it at that and refer you to Chapter 3 of the report for further details on the assumptions as well as documentation of where they come from. So using the basic methodology described earlier in conjunction with the 3 models that I just very briefly described, I looked at 4 scenarios for wind power and 5 for solar. For wind, the most obvious scenario in which the benefits of tax equity would no longer outweigh the cost would be a permanent PTC expiration. I also looked at the implications of making the PTC refundable, which is something that's been included in President Obama's budget requests in recent years. Tax reform is another scenario that's been widely discussed and could have an impact on all of this. And then finally, I also looked at what happens if the cost of tax equity and or debt were to change materially. For solar, I looked at the reversion of the investment tax credit, or ITC, from 30% to 10%. That's scheduled to happen in 2017. I also looked at what happens if you make the credit refundable or award it as a grant, like under the Section 1603 program. The White House's recent budget request also makes solar eligible for the PTC, so I looked at that on both a refundable and non-refundable basis. And then finally, I also looked at the impact of tax reform and changes to the cost of capital for solar as well. Now, it's important to note that none of these scenarios are intended to be prescriptive. In other words, I'm not arguing for or against any of these scenarios. Instead, these are all simply scenarios that have been widely discussed among policymakers and industry participants, and as such, they serve as tangible and useful examples to demonstrate the tools and methodology developed through this work. So after all that background, let's now turn to some results. So here we see what happens in the event of a permanent PTC expiration or phase-out. The three lines shown in the graph represent levelized PPA prices across a range of PTC levels under three different financing structures. Specifically, the dashed purple line at the bottom represents a sponsor with tax appetite. The dashed red line towards the top represents a sponsor without tax appetite that carries unused tax benefits forward in time. And the solid black line represents a sponsor without tax appetite that, in this case, partners with a third-party tax equity investor to monetize the tax benefits. As you can see, the sponsor with tax appetite has the lowest PPA price at any PTC level because it can use all of the tax benefits in real time, and it can do so without having to call in expensive tax equity. The value of the PTC to this sponsor with tax appetite is simply point G minus point C, which comes to about $15.70 per megawatt hour. And just as an aside, this value is about 35% less than the conventional wisdom of $24 per megawatt hour, which is based on a simple calculation that ignores the negative impact of the PTC on the project's capital structure. Specifically, without the PTC, a wind project could support more debt, which reduces its weighted average cost of capital because debt is cheaper than equity. And this declining cost of capital partially mitigates the impact of losing the PTC. Okay, turning now to a sponsor without tax appetite, which is the red dashed line, we can see that the PTC is only worth about $2.70 per megawatt hour, which is point F minus point A. This is because such a sponsor has to carry forward the PTC so far into the future that its present value is greatly diminished, which in turn means that you're actually not giving up much if the PTC permanently expires. More likely, though, a sponsor without tax appetite would enter into a partnership flip structure, which is shown by the solid black line. And in that case, the value of the PTC would be $15.50 per megawatt hour, which in this case is point F minus point B rather than point E minus point B. In other words, as long as the PTC is at least 50% of its current level, this sponsor without tax appetite is better off partnering with third-party tax equity. Once the PTC drops below 50% of its current level, however, this sponsor without tax appetite is better off foregoing tax equity in favor of project-level term debt and carrying forward any excess deductions and credits as necessary. So in other words, the least cost path in this case is angle BDF, which is why the value of the PTC to the sponsor is point F minus point B rather than point E minus point B. Finally, the difference between points F and G is solely attributable to accelerated depreciation deductions. Point G can use them in real time, while F has to carry some portion of them forward in time, which results in a higher PPA price. This same graph can be used to address the question of how much of a project's tax benefits are forfeited to tax equity investors. At the current full PTC level of $23 per megawatt hour over on the left, the value of having tax appetite comes to around $19.80 per megawatt hour, which is point A minus point C. A sponsor without tax appetite can capture only about 64% of this value, which is point A minus point B, by partnering with tax equity. And of course, the flip side of this is that roughly 36% of this value, or point B minus point C, is essentially lost to the high cost of tax equity. The size of this loss increases as the level of the PTC declines until virtually all of the value is lost at point D, after which the sponsor without tax appetite would be better off foregoing tax equity altogether in favor of project-level term debt and carrying forward unused tax benefits as needed. I'm certainly not the first one to have estimated this loss. This is something that's been widely discussed primarily in the wind sector since at least late 2008, when the financial meltdown clearly highlighted the shortcomings of using tax incentives to try and stimulate deployment. So here I've compiled a few other estimates that I've seen or heard over the years, and these range from 15% up to a 50% loss, depending not only on methodology but also on when the calculations were done, since it turns out that underlying market conditions can actually have a big impact on the answer. For example, if I plug in 2009 era wind project and financing, wind project cost and financing parameters, I end up with a loss that is closer to 50%, which is consistent with what others were estimating back at that time. Okay, let's turn now to a refundable PTC. This graph looks very similar to the previous two slides because a refundable PTC only impacts the no tax appetite line, so only the red dashed line. The other two lines, the purple and black lines, have not moved because those sponsors or tax equity investors, as the case may be, can already realize the PTC in real time, even if it's not refundable. So what you see here is that with a refundable PTC, point A drops by about $11 per megawatt hour from where it had been, which makes it essentially competitive with tax equity at point B. Point F, meanwhile, does not move at all because the PTC is zeroed out at that point. So what happens is that line AF steepens considerably under a refundable PTC, which shifts the crossover point D to more like 90% rather than 50%. And this means that making the PTC refundable would essentially mitigate the impact of a PTC phase-out for all PTC levels below roughly 90%. Moreover, this is a benefit that would theoretically not cost taxpayers anything extra if you assume that a refundable PTC does not stimulate any incremental deployment. In other words, the foregone tax receipts from a non-refundable credit like we have today should equal the foregone tax receipts plus cash outlays from a refundable credit. And this means that from a purely revenue-based perspective, U.S. taxpayers and the U.S. Treasury should be largely indifferent between refundable and non-refundable credits. Okay, let's turn now to tax reform, which is something that's been widely discussed over the past few years. In November and December of last year, the Senate Finance Committee put forth a series of proposals that would, in a nutshell, make three changes of consequence to wind and solar power. First, accelerated depreciation would be replaced by a much slower depreciation schedule. Second, the PTC and ITC would be replaced by a new technology-neutral clean energy credit, and that credit can be taken as either a PTC or a 20% ITC. And third, the corporate tax rate would be reduced by some amount, and although no hard numbers have been proposed, here I've assumed that it would drop from a maximum of 35% down to 25%. So the first column, if you will, of this graph represents the business as usual scenario with a full PTC and no tax reform. So in other words, these 3 points here in the first column correspond to points A, B, and C in the previous graphs. The second and third columns phase in tax reform, first by switching to the slower depreciation schedule in the second column, and then in the third column by also switching to a lower 25% tax rate. Finally, in the last 4 columns, the clean energy credit, which in this case is modeled as the PTC, is automatically phased out over a 4-year period, And this happens once the greenhouse gas intensity of the U.S. power sector as a whole declines by 25% relative to 2013 levels. And what you see here is that the no tax appetite structure, which is shown here by the open circles, is essentially unaffected by tax reform. And again, this is because the sponsor was previously carrying forward all tax benefits far into the future anyway, which effectively means that it was already depreciating its investment quite slowly. Meanwhile, the other two structures, which are tax efficient, are hurt by the switch to slower depreciation in particular, while the change in tax rate has very little impact. As a result, the tax equity structure is just barely competitive with the no tax appetite structure under tax reform, and it becomes progressively less so as the clean energy credit is phased out over time. You can also see that the difference between sponsors with and without tax appetite shrinks and eventually disappears during the phase out of the credit, and this is because the slower depreciation schedule is easily absorbed by the project itself, whether or not the sponsor has tax appetite. Okay, the final win scenario looks at the impact of changing assumptions about the cost of capital, whether it's tax equity or debt. The blue box in the top right of the slide lists 6 reasons why the cost of tax equity could increase from current levels. These are all explained in more detail in the report. But at the same time, we saw in an earlier figure that tax equity is currently about 200 basis points more expensive than it used to be pre-2008, which in turn suggests that there is also the potential for tax equity yields to decline. So this figure looks at the impact of both a 200 basis point decline and also a 300 basis point increase in tax equity hurdle rates. Similarly, for the two structures that use debt instead of tax equity, the figure looks at the impact of a 200 basis point increase in long-term interest rates, given that current interest rates are quite low. And what you see is that the impact of these changes is rather muted all around, ranging from about $2 to $6 per megawatt hour. And this is because both tax equity and debt typically account for only about half of the capital stack. Now, this modest shift turns out to be not enough to change how projects are likely to be financed in the business as usual scenario in the first column, but it is potentially enough to make a sponsor without tax appetite more competitive than tax equity under either a refundable PTC or tax reform. Okay, let's turn now to solar. Here I'm looking at 4 different scenarios at both $3 per watt and $2 per watt AC. The business as usual scenario on the left reflects a 30% ITC. There's also the scheduled reversion to a 10% ITC in the middle column, as well as a switch to a solar PTC. And then finally, I look at all of these credits on both a refundable and non-refundable basis. So starting with the business as usual scenario of a 30% ITC, you can see that project sponsors without tax appetite forfeit more than 60% of the value of tax benefits by bringing in third-party tax equity investors in this case. This number is higher than the 36% loss that we found for wind, and is related to the fact that the ITC hits up in the first year of the project, while the PTC is earned more gradually over a 10-year period. In the second column, you can see that the reversion to a 10% ITC hurts all structures, except for maybe the no tax appetite structure. But it's also worth noting that a 10% ITC at $2 per watt still yields lower PPA prices than a 30% ITC at $3 per watt, suggesting that declining installed costs in future years could take some of the sting out of the reversion. That said, it's also important to note that this policy shift will literally happen overnight, while installed cost reductions obviously happen more gradually over time. A solar PTC yields PPA prices that fall somewhere in between a 30% and 10% ITC. So closer to the 10% ITC at $3 per watt, but closer to the 30% ITC at $2 per watt, given that unlike the ITC, the PTC does actually not scale with installed costs. So in other words, at $2 per watt, the fixed amount of PTCs generated by a project make up a greater percentage of CapEx than they do at $3 per watt. Finally, you can see that tax equity is not competitive under either a non-refundable 10% ITC or solar PTC, nor even under a refundable 30% ITC. The fourth solar scenario is tax reform, modeled here at 250 per watt AC. We saw in the last slide that a solar PTC yields PPA prices that fall somewhere in between the 30% and 10% ITC. So here I've modeled tax reform assuming that the new clean energy credit is taken as either a 20% ITC, which is shown in the top graph, or as a PTC, which is shown in the bottom graph. As you might expect, there's not a big difference between the two. Perhaps the most notable difference is that the gap between sponsors with and without tax appetite is narrower under the PTC than it is under the 20% ITC. And once again, this is because the PTC is already spread out over a 10-year period, which means that the penalty for carrying it forward is not as great as it is for the ITC, which is awarded entirely in year one. In both cases, you can see that tax equity is not competitive under tax reform, which is similar to what we saw for wind. And then again, we see that the phase out of the credit eliminates the difference between sponsors with and without tax equity altogether, because the slow depreciation schedule is easily absorbed by the project itself, regardless of whether or not the sponsor has external tax appetite. Now, both of these graphs are modeled assuming an installed cost of $2.50 per watt AC, but in reality, tax reform, if it happens at all, will not be implemented for a few years down the road, by which time installed cost will presumably be lower than $2.50 per watt. For example, the new clean energy credit will not be implemented until 2017 at the earliest, which in turn means that the earliest possible period for the phase out would be from 2018 through 2021. And 2021, of course, is a long 7 years from now. So rather than try to project installed costs out that far and then model tax reform at those lower cost levels, I instead ran the model backwards and solved for the installed cost that would be required to leave levelized PPA prices unchanged from the current business as usual scenario. And that's what's shown in this table, again for both the 20% ITC and the PTC. And you can see that there's not much difference between the two, which shouldn't be all that surprising given what we saw on the previous slide. So by the time tax reform would be fully implemented in 2017, installed costs would have to fall to somewhere between $1.70 to $1.80 per watt in order to leave PPA prices unchanged from business as usual conditions today at $2.50 per watt. By 2021, which again is the absolute earliest that the clean energy credit could be fully phased out, installed costs would need to drop to around $1.40 per watt AC. Okay, the final solar scenario looks at changes to the cost of tax equity and debt, again looking at a plus 300 to minus 200 basis point range for tax equity and a plus 200 basis point range for debt. And what you see is that sponsors with tax appetite really seem to be immune to changes in the cost of capital, at least within the ranges modeled here. Refundable credits outcompete tax equity across the board, except for in the unlikely event that the cost of tax equity were to decrease at the same time as the cost of debt were to increase. And the same generally holds true even for non-refundable credits in the case of a 10% ITC, PTC, or tax reform. Okay, to begin wrapping this up, this graph summarizes most of the wind and solar scenarios that we've just looked at individually. And there are two basic takeaways from this graph. The first is that under current law, tax equity can't compete with a sponsor with tax appetite, but is able to outcompete a sponsor without tax appetite. So that's the status quo that we all know exists today. The second important takeaway, though, is that under virtually every other scenario analyzed in this report, tax equity finds it hard to compete even with a sponsor without tax appetite. These findings suggest that debt and other lower cost forms of capital could be deployed more widely in the future should any of these scenarios actually come to pass. and that shift to lower cost capital will help to mitigate the otherwise negative impact of most of these policy changes. One thing that's important to note is that much of the modeling analysis presented in this report has been done on an all else equal basis, assuming in particular that tax equity investors are unwilling to reduce their target rates of return or hurdle rates in response to any of these scenarios. But it could be that tax equity investors may very well be willing to accept a lower rate of return under some of these scenarios in order to remain competitive. If this were to occur, however, it would really only impact findings about how projects are financed. In other words, whether with tax equity or with project level term debt. It would not really impact the resulting levelized PPA prices, which are of most interest to the analysis. Finally, I'll just note that this work is really as much about developing tools and methodologies to analyze future policy scenarios as it is about the specific scenarios that are modeled and presented in the report itself. The federal policy environment over the next few years is likely to remain rather fluid, spawning a variety of possible future scenarios, including not only those modeled in this report, but also various combinations and permutations thereof, along with others not even envisioned yet. The methodology and capabilities developed within this report will enable more refined and more targeted policy analyses of these scenarios as they arise. So with that, I thank you for tuning in. I hope it was informative, and I'd be happy to field your questions via email at the address shown on this slide, which is mabollinger@lbl.gov. Thanks, and have a great day.